watching Dukascopy TV. I'm Elaine Stenson, and today I'm joined in studio by independent market strategist Bruno Estier, who's here to explain the technical sides of the markets. Bruno, you're very welcome today.
Hello, Elaine.
So you're going to start by explaining the ratio of the defensive sector versus the cyclical sector.
That's right. And on these very heavy charts, we have a blue line here, moving here, which is the ratio, as you said, of the cyclical sectors versus the consumer sectors or the so-called defensive sectors. What is shown here on this chart is above that ratio, the S&P 500 in orange. And also we showed that when the ratio is moving up, the market is moving up, and we put a green arrow. When the ratio is moving down, we put a red arrows because the market usually is going sideways or down.
Okay.
If we zoom up recently, we will notice that since March, effectively we had, and everybody remember the top in May, we had the S&P correcting about 5% or to 6%. At the same time, the ratio of the cyclical versus the consumer was moving down. Why is it so? Because portfolio managers, which are usually invested, have to outperform the benchmark. To do so, they switch from high beta sectors, that are the sectors which are cyclical, which are going up faster than the market, but also on the way down goes faster than the market. So they're switching out of these risky sectors into less risky sectors, for example, the defensive sectors. And therefore, the ratio is moving down, right? The cyclical are the risky one, the defensive on the numerator are the less risky or the safe one, and therefore this ratio is moving down. What we see currently in the mid-July is that this ratio is not making a new high compared to June, while the S&P is making a higher high. Okay. So that could be a warning sign.
Yes, and what's an example of one of these safer bets?
For example, healthcare sector.
Yeah.
The healthcare is always something that you need to do, even when things are good or bad, even if you have a job or no job, right?
Okay.
We see here the evolution of, again in orange, the S&P 500,
yeah.
And we see in black the relative strength. That means how faster it outperforms the S&P 500 or not. And so the two lines are not synchronous. There seems to be one is moving up when the other is moving down. That's exactly the quality of these defensive sectors, right? It is a safer bet.
They're quite similar though. They're quite close to each other except for this part here.
That's right, they're quite, but if you look now recently, the S&P 500 is moving flat, on a flat line, that's the black line, but you see that the strength of the healthcare sector is moving up relative to the S&P. That means that even though the S&P is flat, the healthcare sector is moving up, and that's what we see here, right? We are making new highs on the healthcare sector. We are coming close to these big blue lines, which is something like a ceiling, right? Okay,
so you said they're a safer bet, so they're a lower risk. So does this mean there's a lower reward?
There is a lower reward if the portfolio manager remains in this sector even after the market has finished its correction. Therefore, if we take, for example, the next chart, which is the cyclical, an example of riskier sectors, every time that the correction is over, then portfolio manager will switch back to the more risky sector, for example, discretionary, which is a fridge or a TV set that you don't buy every day.
Car industry?
Car belongs more to the industrial, but it is also cyclical. That means it is also going with the market.
Okay.
And what we noticed here is a higher high in the discretionary, but we noticed on the black line that the S&P is flat, and the orange line shows that this discretionary sector is not outperforming the S&P.
No, not at the moment.
And this is because smart portfolio managers are moving out of the risky sector, consumer discretionary, into, for example, healthcare. That could be a sign for something else, right? Last time we discussed the measure of fear, namely the VIX. At the same time, we have some warning signal on the sectors. We have an indication that the price of insurance against a decline in the market, the VIX, is at a very low level compared to what happened in May at around 11-12%.
Okay.
So that could be a confirming signal.
This is the time to buy then?
This is the time to buy a protection, because this is the price of protection, and the price of protection is low.
Okay.
Now we have another late information eventually which could call for a correction in the market. This is what happened in the last 3 days in the Nikkei. The Nikkei moved from 14,900 quickly to 13,300 in 3 sharp down move in the last 3 days.
What was that caused by?
We don't care as technical analysts what was caused by. We just notice it happens. The same way we were noticing in May that there was a sudden big 7% down day. And that arrives before the market topped in the S&P. So maybe we might have another warning signals here. We need to monitor that.
So these are warning signals because it's going down?
Yes.
Okay. So when do we think it's going to go up again?
Well, we will let the market decide. We have some idea where the support or the floor could be. This is the same area of 12,600 as we mentioned in our interview in May. And we have mentioned before that 15,000 was the ceiling. So we are waiting now to meet the floor. When we will meet the floor, we will see.
Okay, great. Okay, Bruno, that was very interesting stuff. Thank you for joining us today.
You're welcome.
And that's all we have time for now, but do stay tuned to the Dukascopy website. We have more updates and interviews coming up later on. Bye for now.